Good evening, Marshall Reddick investors. Welcome to tonight's webinar covering the topic of making a fortune in multifamily units. Hope you're all having a great night. My name, and I will be hosting this entire webinar, is Garrett Stason, and I am a real estate advisor here and realtor at Marshall Reddick Real Estate. So tonight we'll be covering the top markets, especially for multifamily and multi-unit properties, how to set proper expectations based on property class, and then also predict your 15-year projected return on investment, which is a difficult thing to do, but taking the right steps, we can certainly get you going in the right direction. So I've set aside about an hour to cover all of this material, and if I'm going too fast or if you have questions, since we're not going to get to everyone's questions here, please feel free to reach out to me via email, and then I'll also provide you with my contact information later on. So without further ado, let's get started. All right. So I always like covering this slide because we have a wide array of mixtures as far as people who are brand new to Marshall Reddick, or they've been with us for a number of years, or they've invested with us about 15 years ago, and a lot has changed since they started up again. So I always like covering this with every webinar and seminar that we put on. So the top part I really like to explain or go over as what we do here locally in California. Since we are, our offices are located here in Newport Beach in Orange County, it's only right that we are a California broker. So part of my role as a dual hybrid, I am a realtor here, so I help clients purchase, whether it be their primary residence or investment property, along with the sell side as well. So our team, and every one of our teams, is licensed to do that. We are also a private money lender, so those who cannot qualify for conventional financing, we do have the options available to you if it makes sense to use private money lending, which I'll get into in a little bit. And then finally, here in California, we are a property manager. So we manage property, single family, multifamily, stemming from LA all the way down to Orange County. So literally from Thousand Oaks, Burbank, down to San Clemente here in Southern California. So the bottom part in the blue here is really what we've been doing or known for close to 40 years now. What we do is really have teams set up in each one of our designated markets outside of California to help people purchase investment property. So the other part of my job as a real estate advisor is to walk clients through the process of purchasing property, but doing it the right way, getting you in touch with everyone on our team, and making sure that your questions are being addressed as a one point of contact. So in each one of our markets, we have one realtor that we hand select, one property manager that we hand select as well, who's really going to be the backbone of the transaction process when purchasing out of state. Of course, once we've gone through the due diligence process of where to invest. Along the way, there comes the supporting staff with that, right? So you have your lenders. Who are you going to be using for lending? How are you going to be purchasing the property? And then, of course, insurance agents, any CPAs when there's tax questions involved when purchasing real estate, attorneys, and a lot more. So the benefit of Marshall Reddick is to utilize every one of our teams, members of our team, every branch that we have to offer you. So by utilizing us, you're really going to have a hands-off experience when purchasing real estate. So again, I essentially covered this for you, but we really do make the process within buying here locally or out of state very simple for you, one point of contact, but going through all the proper steps in order to do that successfully. And it's very cliche, but it really is true when you look at everything that we do here as a company. It is a one-stop shop regarding. Doesn't matter if you're buying a property, doing a 1031 exchange, selling a property, you really get every one of our services, especially if you're looking to lease out a property here locally. So finally, for those again who are familiar with us, we are a believer in long-term buy and hold. So that is the most beneficial way to capture the most growth and return on your investment the longer you hold the property. So I am going to explain to you a little bit about myself here, since you're probably going to be wondering who's speaking for the next 50 minutes or so. I'm a licensed realtor here, graduated from Arizona with a bachelor's degree in economics, and I have family in the industry, so that's what got me started and really motivated me to, get into real estate. Before I was working here at Marshall Reddick, I was a financial advisor for 3 years, so it really helped me understand the process of advising clients. And what I was doing over as a financial advisor is exactly what I'm doing now with clients, except just focusing or having a strong focus within real estate. So let's get started. Marshall Reddick is in 16 major metropolitan markets across the U.S. As you can see here, stemming everywhere from California, Nevada, Arizona, Texas, Indianapolis, Tennessee, and then Florida. So you can see we're in a wide range of geographical locations here across the United States. So I'm going to get into the best markets we feel for multi-unit investment property. But before that, let's figure out, why we're investing, or what's the benefit of investing in a multi-unit property. Less competition, and what do I mean by this? So, they're not only, you're not only purchasing single-family homes. I mean, there's more single-family homes than multi-family homes, especially in the suburbs of these large metropolitan markets. But not only that, you have two groups of potential buyers looking for single-family homes. You, of course, have people who are looking to purchase them as their primary or possibly as their primary residence, but you also have investors looking at them as well for, obviously, an investment purpose. Now, this is not to say people purchasing multi-units only for investment purposes, but majority of people who do purchase multifamily properties do use them for investment purposes. It usually takes more of a more experienced investor to buy multifamily. Usually people who have little to no real estate experience tend to look at single-family homes, right? There's only one tenant you need to worry about at a time, one door to look at, one check that you have to look forward to, or just make sure that comes in every single month. Essentially what that equates to is less of a headache for you and less things you need to keep track of, especially when you have a full-time job and a family or a life outside of real estate. You tend to find more experienced or seasoned investors who understand the process and really understand the proper expectations when purchasing multi-units. We're seeing a lot of this going on right now with our clients here at Marshall Reddick. A lot of our clients end up doing this exact same thing, as far as buying or starting off with a single-family home and then eventually purchasing another property that's a multi-unit, or doing a 1031 exchange. So multiple avenues that you can do that through. Here's another page that I always like to go over, which is pretty self-explanatory, but essentially what it is really the economy of scale, right? The more units you have, the price per square foot decreases. Same thing with cost per unit decreases the more you have. Just for those of you who are looking to purchase here in California, or are familiar with or aren't familiar with this next tab, is if you do own more than 16 units on one structure, you have to have a designated responsible person that is required to live on the site. So here are some common factors that people like to take into place when figuring out what's going to make the most sense for them, right? We always hear the term cap rate. We always hear cash on cash and ROI, right? Here are just some basics as far as understanding how we come up with cap rates, cash flow, and ROI. Cap rate, which is really the most common formula specifically for commercial investing, is used here, right? So you take your annual net operating income, what you bring in as far as your total rents minus all of your expenses, divided into the cost of the current market value of your property. Cash flow is another thing that a lot of our clients look at. It could be used for both multifamily and single family, and it's the annual before tax cash flow divided by the total cash invested that you put down as far as your down payment plus any of your closing costs. And then, of course, return on investment. This is really going to give you the long-term approach of how well your property did do or did not do. So return on investment is the profit of the sale divided by the total cash invested into the property over the number of years held. Pretty simple, right? But how do we actually get profit from the sale? So all of our examples are, as far as what you see on our website, are all going to be defaulted to a 15-year time frame. That is a long enough time where you have ups and downs in different sectors of the economy that take place, which is really going to show you a good average or median return on your investment. So how are we going to do this, or how are we going to calculate profit from the sale over a 15-year time frame? So what we do is we take how much cash, net cash, did we bring in every single year for 15 years. We're going to look at the equity from the principal pay down. So how much of your mortgage was reduced each month over 15 years that the tenant paid. We're also taking into consideration vacancy numbers and maintenance numbers, which I'll get into in a second, and how we're going to estimate those numbers as well. And then, of course, the equity from the appreciation. In each one of our examples, in each one of our markets, we do have statistical graphs and numbers to support a percentage that correlates for each metropolitan market as far as median home prices and where the trend is heading. And then, of course, we want to factor in selling expenses, which we typically can estimate about 9%, right? It's going to vary between each person and transaction. But you have 3% commission to the buyer side, the seller side, and then, of course, any closing costs. So the good news is when you purchase property or real estate, you don't pay any commission, which I'll get into. And actually, it's a good point for me to just harp on real quick. We're a free service to you. That the way we make money here at Marshall Reddick is the same way any other broker makes money, right? On the transaction side of real estate. So we don't charge for any information on our website, videos, market data packets, consultations with myself. We only make money through the transaction of real estate. All right. Hopefully you guys didn't think you were just going to sit there and not have to participate, but I want to get you guys involved here. So I am going to do a quick poll for us here. Now this is an anonymous poll, so don't worry about having your name attached to it, but I do like to get you guys involved with this process. So without further ado, which one of the following best describes you? All right, so as you can see there, I'll give you guys about 15, 20 seconds or so to answer these questions here, and then I will go over them in a second. All right, we've got about 75% of the people voted. We'll give you guys another 5 seconds or so. Okay. Close. Share. All right, so we have a mixture of, every single one, which is great. So we have people who own multi-units, some who don't own multi-units. but I really like to get a gauge as far as the audience and your experience and within purchasing real estate as a whole. So that's great. Thank you for participating here. All right, let's move right along. Okay, so we've established, we want to purchase multifamily, but now what, right? Where do I go from here? So as a real estate advisor, my job is to really help answer these questions through a series of more questions. I really need to understand you and your goals first. Are you looking to build long-term wealth or produce the most cash flow? So before we go on from here, your answer might be a direct correlation to the following question, which is, when are you looking to retire? How much experience do you have? Um, the retire question really gets an understanding as far as the cash flow or long-term wealth building, right? If you're close to retirement and you're looking to supplement income, maybe cash flow is going to make the most sense for you. If you have a longer time horizon, you don't, tend or really need cash flow, but you want to add this to your retirement plan and diversify your assets, then maybe a long-term buy and hold strategy where you won't make as much as far as cash flow, but the market that you're in is really going to dictate your total return on investment. So which one of those are you? How much experience do you have? I always like to associate experience with the number of units you're willing to take on. Usually, the more experienced investor who has done this, multiple times or for a number of years, isn't going to necessarily buy, a single family or duplex. Maybe they have all the experience and the expectations of what comes along with the process, where they're looking to really get into 4, 5, 6, 7 plus units to really add to their portfolio here. And then, of course, right, how are you going to pay for this? If not cash, if not for a 1031 exchange, or if you can't qualify for conventional financing, how are you going to pay for it? Of course, what can you afford? We will certainly need to make sure the properties and locations are in line with financial budgeting. Now, going back to the first question of income or long-term wealth, here is really where we help you determine that. So the scale below here represents property classes. And really, as you can see, towards the left of the scale with luxury and A-class, those are the properties that are in, better school districts. They have a higher purchase price, so that those are typically going to be higher than the median home price of that particular metropolitan market. Along with the better school districts comes along, usually a better tenant quality, more family-oriented, someone who's owned in the past, looking to own in the future, type of tenant involved, right? And then as we go down the scale to B class and C class, you can typically see the a different type of tenant, right? More cash flow because you're getting that property at a lower purchase price than you would with an A or a B. But you also typically find different types of tenants involved as well. Sometimes they're going to be short-term, maybe not as much long-term you'll see, especially in the C class. More blue-collar workers here. So in the next slide, I'll be able to show you what you can really expect for each one of those property classes. And this is all in our property ebook, which you can download on our website. It's about I'd say about a 45-minute read, and it really goes into the weeds and deeds of property classes, how to identify property class based on a metropolitan market. And I want to cover two things here. So things that matter and things that matter very little. So things that matter, of course, are going to be the price point, right? So of course you want to find a price that's going to be affordable, especially in that area. You're not overpaying for it. What's the cost per square foot? And then, of course, really good things to look at when setting up an area to invest in is going to be looking at the school districts and then also the crime rates. So also things that matter very little when investing in real estate, whether it's a house, condo, or an apartment, the age of the property size, and of course the property condition. Okay, so like I mentioned earlier, to get the return on investment, you have to be able to factor in unexpected things that occur, of course, within that 15 years. And how do we do that? So you're going to have vacancy and you're going to have maintenance, right? Of course, we all don't want these, but you can typically expect to find these, and they're all going to vary based on property class. Like I mentioned earlier, when you're looking at A-class type properties, you can typically find a lower maintenance number associated with that and a lower vacancy number. Now, first, let me start off by saying that these numbers may look high to you, and that's fine. Or you can always adjust these. These are not something where the 8% or the 10% is going into my pocket. It's all going into your bank account at the end of the day. All we're doing is giving you a realistic expectation. If you look at that property over 15 years, right, the highs, the lows, all of the vacancies, the maintenance issues, what did you typically incur when factoring in for your either your cash flow or your return on investment? So here we factor in 8% for A class, B class is 10%, and C class is 13%. When you get to 5 or more units, you can tend to find these types of numbers or use those as a guideline, right? At the end of the day, you can use whatever you want, but this is what you can typically expect to find over a 15-year average, right? If you looked at the property that you purchased in 3-4 years, these numbers are not going to be anywhere near what you're experiencing when it comes to vacancy or maintenance. When you hold on to the property for the long term, this is where these numbers really hold true. So just to kind of give you an example of how these numbers work, right? So we'll just take an A class, for example, right? So there's 365 days a year. We take 8% of that, which is about 30 days of the year you can expect to find vacancy. Or what you can take out every single month and put into your savings account or a separate account. So 30 days as far as vacancy, and in that 30 days, there's a lot that happens throughout that time frame. So when a tenant leaves, the property manager has to do a lot of work to it. It could be a lot, could be a little. We don't really know, right? But what you can typically find is they do all the paperwork necessary to get the tenant out. They're going to call an inspector to look at the property. First, they're going to do their evaluation of the property, what needs to be fixed, what needs to be replaced, call contractors, get the scope of work, send that information over to you, you approve it, they come back, they do the work, they complete the work, they send that back off to you for your approval, all while interviewing, doing background checks, marketing the property, conducting interviews. There's a lot involved also while managing other properties well. So 30 days is a pretty conservative number when looking at a vacancy for A, B, or C class in the long run, right? There's some areas depending on the short term or the past few years where you're going to see a lot lower of these vacancy numbers. Like I was mentioning earlier, we do have the Property Reddick ebook, which goes into in detail the A, B, and C class, what markets you can find as far as a median home price. If you click on interactive maps within that book, it'll take you directly to the websites of where we get this information from. Okay, so a huge part of real estate is being able to not only do your due diligence and figuring out what market's going to make the most sense and have all your cap rate numbers in hand, but also how are we going to be paying for it. We always want to make sure if you're not doing cash that you have the option to go through conventional financing because it requires the least amount down and it's going to also give you the lowest interest rate. So just as far as an example here, a really visual breakdown of what you can expect to find. So one unit is going to be 80% down, or sorry, 80% financed, 20% down with a mid FICO of 680. Same with 2 to 4 units. The only exception is you're going to have an extra 5% down. Same thing if you have 5 or more properties financed. So if you have any questions on this, I can certainly go into more detail with you on this, and then of course get you in touch with our preferred lenders that we work with. All right, who is ready for another poll question? Let's get started. I know how much you guys love these. Okay, which of the following best describes you? Let's see. Best describes you. I am already pre-approved. I want to invest, but I'm not pre-approved, or I'm just here to learn. So I'll give you guys about 15, 20 seconds to answer this, and then I will go over the answers at the end. All right, we've got about 80%, almost there, guys. Okay. Perfect. All right, so we've got about 12% who are already ready to go, pre-approved, which is great. We've got about half of you, or a little less than half, who are looking to invest this year but are not pre-approved, which is fine. And then, you know, another great aspect of doing these webinars is attracting those investors who are just here to learn. So glad to see and thank you all for participating. We have 2 more, so stay tuned. Okay, so what are ideal markets for multifamily investing? We've mapped out 3 of the 16 that we're in. You know, Southern California, San Antonio, Texas, and the southwest part of Florida, and the Fort Myers, Cape Coral, Lehigh area. So why these markets? So they have to have all of these check marks next to them before we can establish them as great markets to invest in. Of course, they're going to have jobs that's going to sustain the economy, that's going to be a driving factor for not only the short term but a long term duration. Are the states that we're in landlord friendly? Now, yes, California may not be the most landlord friendly, but I will get into California. It's really kind of an anomaly as far as California being a good place for multifamily for certain reasons, right? We're also going to look at the cost of living. The price to rent ratio is going to be higher than most. Low vacancy, economic diversity, strong education, and of course reliable property management. So we're going to start on the east side of the United States and take a look at the southwest part of Florida. All right, so just for those who are not familiar with this area or where it's located, this will give you a good understanding of these markets, or the lead county is really what we call it, that's going to entail these particular markets. So to give you guys an understanding of who we work with, right? Hopefully you mentioned, or you remember me mentioning that we work with a hand-selected real estate agent. This is Terry and Ken. Some of you who are familiar with Ted and Carrie know how well of a job that they do. They've been with us for, you know, close to 15 years now, and just do an exceptional job and they're extremely good at what they do. So in each one of our markets, like I mentioned, we do have one team that we work with. Okay, so I'm sure you guys probably do a lot of research on your own as far as what are the best markets to invest in. Really, Cape Coral is no stranger to the top spots on Forbes list. Especially in the mid-2000s, they held the #1 spot as the fastest growing city for a few years in a row. Of course, we had the 2008-2009 crash, but they're actually making their way back up. And the biggest positive out of all of that is the lending guidelines have dramatically helped the fear factor, especially with people who are looking to invest in Florida. So that is a benefit when moving forward and having that hesitation as far as, are we approaching another bubble? Are we approaching another cycle of the market where we're going to see a huge drop? that is not something we see, specifically because, or one of the many reasons is because of the lending guidelines. Okay. Here we have more stats on Cape Coral, population growth. It's not a small town, right? You can notice that each market we're in is a large metropolitan market where you have a lot of jobs, a lot of people that are sustaining the economy, right? If you're in a small area where there's only about 10,000 people there, what is that really doing, or what is that saying about your tenant prospects? Or, you know, when there are vacancies, how much longer is that going to take to fulfill that vacancy? But not only that, the right tenant or the right prospective tenant. Along with that, you have less competition when it comes to property management. Whereas if you're in a small town, a small area, you may only have one or two property management companies that dominate the entire area. That being said, you're not going to get the best customer service with that, right? They know you only have one or no other place to go. So when you're in a large metropolitan market and you have different property management companies to choose from, it really is going to come down to customer service and who can give you the best rate. Cape Coral has really grown, especially since 2008, 2009, as far as a robust economy. There's a lot of development going in and around the Cape Coral markets, also due to the fact that labor costs are extremely low. Land is cheap, same with the workforce. So all those being added up, you're going to find very good properties at an exceptional price in Cape Coral, along with the extreme high demand of rent. So this is one of the markets where the rent ratio versus the first-time home buyers or primary buyers is going to be about half, or about 45%. So the population growth also in Cape Coral was at almost 4% in 2016 and predicted to keep expanding according to Forbes. Just more great information on the Lee County. And when I say Lee County, I'm referring to Cape Coral, Fort Myers, Lehigh Acres. Speaking with Terry, speaking with our property management team in the Lee County market, over the past few years, they have noticed close to about 3% vacancy rate, which is crazy. There's so many jobs and so much demand to live in the Cape Coral market, and the Lee County market, that vacancy rates are extremely low and continue to be extremely low. Also, what does low vacancy rate mean to you, right? It means more jobs are being brought into the economy. There's more demand to live there, more money coming in, which leads to more infrastructure and long-term growth for that particular region. Okay, so this is a graph of Fort Myers, Florida, and this is going to show you a few things, really cool and neat features here. And each one of our markets is going to have this exact same thing. So first thing I want you guys to look at, excuse me, is the heat chart, right? The A, B, and C class property. So how we actually factor in A-class property is looking at first the median home price of that metropolitan market. So the median home price for Fort Myers, Florida, as of the end of 2016 was $227,000. So that's what we put at 100%. Anything 1.3 times that amount is what we consider an A-class property. A B-class is going to fit into the 80% to 100%, and then C-class, of course, 50 to 80%. We do stay away from luxury and D-class. Luxury is the price point to really make any sense when it comes to investing, and then D-class, especially for first-time investors, is really going to be Section 8, headache, nightmares. Is the tenant going to pay this month? Are they just going to get up and vacate? What are they going to be doing to the property as far as treating it and keeping my maintenance low? Another really cool thing about these charts is, and we get all of these from the National Association of Realtors, by the way. This is all directly from their website, and looking at close to the 26-year graph of the median home price, and you can see the changes in the median home price. So Florida is one of those markets that's a little bit more volatile than others. It's similar to California. It's similar to Arizona when it comes to the volatility, right? When the economy is doing well, you're going to see a very rapid increase as far as price points. And then also on the other end, when the economy is not doing well, you'll tend to see that fluctuate as well. So this is all in a market data packet that we've provided you guys for free that you can download on our website, marshallreddick.com/Cape Coral. You know, it's about 15 pages worth of demographics, economic numbers, charts, pie graphs, job growth, a lot of statistical numbers for you to get familiar with the Cape Coral market moving forward. If you have any questions or need help finding it, let me know. I'll send it over to you. So you guys are here, of course, because you want to, you know, learn more about properties and see properties. So I've provided, for each one of our markets, we're going to get into the ROI and breakdown of each property. So here we have a property here. It's a B-class property in Cape Coral. This one happens to be a 4-bed, 2-bath. And you can see on the right-hand side, or sorry, the left-hand side, just the description of this property. This one happens to be a duplex. The list price is $278. The down payment is 30%, and that we've calculated that number out for you. Any initial repair costs that are in there are what we've predicted or what you should set aside to get the property rent ready and to get the most out of it. So it could be replacing carpets, could be paint. You may have to pay $2,500. You may not have to pay $2,500. It's just really just an estimate for you to set aside to before you get into the property. And then, of course, we've also estimated your closing costs for you based on the loan amount. So initial capital needed to get into this property is $93,000 roughly. So here, this particular property is rented at $2,500. We're factoring in your mortgage payment at 4.75% interest rate, and in all of our examples on our website, you can change the interest rate for your qualification. Taxes, you have insurance, you have your management fee. There is no HOA or utilities or landscape. So you have your total expenses broken down for you. So what you bring in every single month, if you don't incur a vacancy or you don't incur maintenance, is roughly $814. Remember, we factor in maintenance and vacancy based on property class for every single month. This is what money you should set aside in case these do occur. Now, leasing fee, we also factor in that as well. A leasing fee is what a property manager charges to replace a tenant in your property. So we factor in about every 18 months or so over the course of 15 years, you can expect that to happen. So we just take half of 1 month's rent divided into 18 months, which is how we get close to $70. All of that taken out, your net cash flow is $244. So, right, how much of that? So 244 times 12 times that by 15 years, you know, plus your principal pay down over the 15 years, plus the appreciation growth, minus your selling expenses, gets you over 15 years a total projected profit of $223, which is about close to 16% return on your investment. Here's another property that we have here in Cape Coral, Florida, and this one is list priced at $249. Same numbers, right, that we're going to utilize here. Monthly income of $886, monthly cash flow of $317. These are all on our website as well. Here is a fourplex. So a fourplex here is priced at $429. The rent is $3,800, and this one here are all fully rented. Get a monthly income of just a little above $1,200, and then once you take out your expenses, you can get about or expect about $374 as far as cash flow goes. All right, Florida property poll. Let's do this. Which property of Florida did you like the best? Was it the first one on 1037 Southeast 11th? Was it 1835? Or was it Southeast 4th? Southeast 4th. So I'll give you guys a few seconds to complete this, and then we'll go over these polls as well. And again, if I'm going over these properties fast, that's because I'm just conscientious of your time and where we're at with the PowerPoint, and I can certainly go into more detail with you on this at a later time. Just do email me though, because my schedule does fill up fast, so it may be something where we have to do in a couple days, or if I have time available as soon as possible, I will let you know. But just email me if you have any questions or would like to set up a consultation for free. All right. So we've got about 15% who like Southeast 11th, 31%, 1835, and then 54% on the fourplex, which is great to see. Okay, let's continue right along here. San Antonio. I'm going to go over this here shortly here for you guys. Okay, again, just like Florida, we have Christine here, who we've been working with for a long time in San Antonio. She has a lot of experience in the real estate industry, including 10 years as a mortgage broker. So Christine's awesome. You know, we all have multiple conversations with each one of our agents. I'd say at least twice a day, just because of how many people, especially with our clients, are investing in these markets that we need to make sure that we're on top of. Okay, so San Antonio. A lot of big businesses and military bases is really going to describe San Antonio. Some of the larger companies that are here, USAA, you have Valero Energy, you have Tesoro Corporation, you have CST Brands, which is a publicly traded fuel and convenience retailer, and then also iHeartMedia. You have a lot of attractions here. SeaWorld's a huge attraction. You have Six Flags, and then of course military bases as well. So Fort Sam Houston is one of the larger ones here in San Antonio, and it's really a military-based town, or one of the larger military-based metros in the United States. All right, just again some of the companies, some of the attractions. You have large universities here as well, which is going to attract bright minds and also get them implemented within the large metropolitan as well. And of course, the San Antonio Spurs, which is a huge attraction and a big fan favorite of a lot of the people here in San Antonio. So this is a cool chart here. It really just shows you a chart here from the San Antonio Board of Realtors, and it's really going to go over the last 3-4 years of sales, home prices, and then just the upward increase in trend, right? It's not something where, and let me just add, Texas as a whole, specifically San Antonio, you will not see large fluctuations in the market when there are trends and then downtrends. It's a very steady, pumping along trend, which I'll show you here in a bit. So why San Antonio? And some of you may or may not have heard of New Braunfels. It's an area in the northeast part of San Antonio, and it's really unique because, and why it's growing so fast, is not only the fact that it has extremely good school districts, but it's also 30 minutes from downtown San Antonio and about 45 minutes from downtown Austin. What that's really doing is giving people more of an option to live there as far as a commute goes. If their spouse or significant other is living in one of these areas, and they have a job in another area, it really just helps with the location geographically. A lot of families are moving there because, again, the school districts are extremely well into getting their kids implemented in that system. San Antonio is a large metropolitan market, extremely low, or I wouldn't say extremely low, but it has a lower than national average cost of living, which is great. Unemployment rates are low, which is amazing as well because, again, you have the demand to live there, the jobs there, and the sustainability. Just more information and stats on San Antonio as far as population growth, year-over-year growth, and home prices as well. Really solid area to be in. So if you remember from the Florida market, you saw a little bit more of a fluctuating chart. Here is a little bit, San Antonio is a little bit different. San Antonio is going to be at a little bit lower price point than Florida, as you can see by the median home price of $206 versus close to $230. So it's really going to help a lot more people get involved or get more interested in San Antonio because of the price point. Same thing. I can spend hours on each one of these markets for you guys, but due to time, I want to limit this, and this is all stuff you can find on our market data packet. So let's get into the good stuff. So remember these homes so we can go over which one is going to be your favorite. So here we have Gulf Way in San Antonio. It is a duplex here. You can see the list price of $215, the rents, the monthly income, and then the cash flow. Now, I will tell you right now that you can tend to find more cash flow in parts of Florida than you will in San Antonio, but you will have more of a steady growth in the long term with Texas, San Antonio, and more appreciation here as well. As you can see generated here with the 17.29% annual ROI. Here is another property in San Antonio. This is a fourplex here, priced at $350. The rents, monthly income, and then of course your annual ROI. C-class property here. All right, let's do it. There's only two here, so let's do the San Antonio poll. And let's see, get this thing going. All right, so which property in Texas did you like the best out of those two? All right, I'll give you guys a couple more seconds here. All right. Got about 37% like the duplex on Gulf Way, and then about 63% like the property, the fourplex on Silver Sands. All right, of course, Orange County, Los Angeles. I love California. I've been here my entire life except for 4 years, except out of state. It is one of those unique markets where people still, no matter the price point, no matter some of the landlord laws and who they protect, still invest here, and there's great reasoning for that. Southern California is going to be, of course, a very high appreciating market. Regardless of what the market does, if it goes down, it's always going to bounce back. And that's very true for most places or all of real estate, I should say. But there's really like a special factor when it comes to Southern California investment property primaries as well. It will always appreciate. You may not find cash flow here, or much at all, unless you're putting close to 50% down or more. But what you will find is a long-term growth, long-term appreciation. So back to my beginning slides, some of those who can afford to not have the cash flow right away, but are looking to add to their portfolio, this may be an opportunity to invest here in California if you can do so. and let's just get into it. But that's not the only reason why California is one of the great places to invest in. Prop 13 is huge, right? So this is especially beneficial for the long term, or the longer you hold your property, especially if those of you who own here have owned for a number of years, right? So the benefit of California versus anywhere else in the United States is that it sets the property tax rate at 1% of the assessed value from when you bought it. Another benefit of Prop 13 is that it restricts the annual increase of the assessed value not to exceed 2%, whereas other markets where you do see a high fluctuation of median home prices over the course of 3, 4, 5 years, that's really going to add up when it comes to property taxes, where here in California it is capped. So if some of you who have owned here in California for 15, 20, 30 years, hats off to you, and you're still holding on to it, you're paying very little in property tax, which is huge, especially here in California. Another benefit of California properties is that insurance rates are low. And some of you are probably questioning why that is. Well, unlike most parts of the country where you have the ocean to, the west of you, that's going to really is going to increase not really so much the structure of your home, but the land it sits on. So when insurance agents are quoting you, they're quoting the value of your actual structure of the property. So let's just say $1 million property here in California, the home may own, the structure of the property may only be $350,000, $400,000, whereas the land is going to be way more than the actual value of the property. So really, you can actually, that's being very conservative too. Typically, you can find the 80% 20 rule, whereas it's going to be 80% land, 20% value of the home, whereas most places elsewhere in the United States, it's going to be the exact opposite. There's a lot of benefits to be here in California. Here is a graph of Orange County over the last 26 years. Just a little bit different as far as the median home price goes. We've gone from 230, 206 to 740,000. So really what this is also going to show you is the types of tenants you can expect. A C-class in Orange County is going to be the same C-class type of tenant you can expect to find in San Antonio or Florida. So even though a C-class property is living in a $400,000 property here, which is going to be a luxury class in pretty much 95% of the markets elsewhere, that's still going to be the same C-class tenant, or the type of tenant who's living in a $120,000 property in San Antonio. So if you have questions on that, that's what the ebook is going to be for. All right. This here is a duplex which we are actually under contract with currently. One of our investors had an accepted offer on this property. Just to give you a little bit of an idea, I'm not going to name any names, but the person who purchased the property, has a very well-paying job, doesn't have too many expenses, no debt, and is really looking to add towards his 401k, his portfolio. So looking at it at a long-term investment, he's not really getting the highest cash flow, as you can see, right? He's still coming out of pocket if he were to factor in the vacancies and the maintenance and all of that, but he's looking at this as a long-term buy and hold strategy. So that's, again, to show you the benefits of using or investing in an appreciating type market. Okay, so for those of you who are familiar with social media, hopefully you guys are, connect with us on Facebook, Yelp, LinkedIn, and a bunch of other social media websites. And before you guys go, this is what you can expect to find from me in a consultation, whether it be our first one, our fifth one, whatever it is. these are the things that we are going to cover, right? First, figuring out why you're investing in real estate. If you don't know why you're investing in real estate, this isn't going to be the thing for you to do. You really want to figure out what is the driving factor behind you investing in real estate. How are you going to be paying for it? What are your options? Is there another beneficial option that you didn't know or were aware of? What does your time frame look like? Is it 3 weeks? Is it before the end of the year? Is it within the next 2 years? Do you have a goal? Or is it something where you have a plan saved up for, or a plan to save a certain dollar amount each month, and it might be in 4 or 5 years? I see that all the time. Setting your criteria. This is probably the most important one that we will cover. Going over property class, the types of property, whether it's a single family or a multifamily. What's your risk tolerance? You know, how much experience do you have? When are you looking to retire? This is really going to be setting your criteria. Where, of course, we're going to figure out what's going to make the most sense for you to invest, or where is going to make the most sense for you based on your time horizon, risk tolerance, how you're going to be paying for it, and what you're looking for in a property. And also who. You know, you're obviously going to be working with me as your main point of contact, but of course getting you in touch with the right people so you don't have to go out of your way and do your research and, you know, interview property managers, interview real estate agents, and so forth, right? You know, a funny thing that I always like to say is there's a reason why we're in so many markets. You know, if you went online right now and had an interest in, let's just say, Phoenix, which is a market that we're in, and you were interviewing agents out there, and you ask the question of, you know, what's the best place to invest in real estate, they're of course going to say Phoenix. So that is a really big benefit, because we're not going to pinpoint you or pigeonhole you into a certain market, right? If one market doesn't make sense, there's going to be another one that does, and we just need to figure that out. So thank you all for joining me on this webinar tonight. I really appreciated you taking the time out of your busy schedules. Like I mentioned earlier, you can contact me for a free consultation. And I don't know why I keep saying free, because they're always going to be free with us. So give me a call, email me, and let me know what works best. My calendar, like I said, does fill up. I do about 15 consultations, 10 to 15 consultations a day. So as you can see, my schedule does fill up relatively quickly. If you have any other questions, yeah, like I said, let me know. Other than that, have a great rest of your evening, and hope to see you guys all at later events and or webinars. Thanks so much. Have a great night. Bye.